Hello, welcome back. So I have made a couple of videos about Snapchat, which was down about 27% after its earnings report, pretty much. It was completely annihilated, dumped tremendously, and it looks like Meta is actually also going down about 4% as a sympathy play because all of these companies have a lot to do with advertising. And so, if you see any weakness in advertising in any of these companies, it kind of gets transferred to the performance of the other ones. And so, while Alphabet, for instance, hasn't reported yet, and we are expecting its report soon, it's still down 2% in the after hours market, and it's currently below $100, which I think is an insane price, frankly. And it's one of the companies that I do hold, and we're going to be taking a little bit of a quick look here, just because I know that a lot of people are actually going to be interested in this one for good reasons, of course. And we do know that we're expecting its earnings report. You can kind of see here what to expect from Alphabet stock after earnings. So its shares were higher yesterday, that is. But you will see that the Google parent will step into its earnings confessional after the close on Tuesday, October 25th. So it's in about 5 days or so, in which they will report their earnings. Now, I think I bought Google when it was at about 125, something of that sort. I'm not really sure. But I did consider it a fantastic opportunity back then. And what about now? It's down to less than $100. And so we're going to be examining the financial details of the company and see what is the price to pay for it today and whether it's a good buy right now. And trust me, it is. So we're going to be taking a little bit of a closer look here. But you will see that based on the Alphabet's earnings history, the stock has closed higher the day after reporting in all but one of the past 8 quarters. So for the most part, it grows higher. That doesn't mean much, of course, because currently in the current market, everything goes down, and this may continue for a little while. So regardless of how good the company is, and regardless of how average or even good in some situations the earnings report could be, you can still see these companies pretty much go down after their earnings report. Now let's go back, and you will see here, of course, there are some news, usual stuff about some suits that you're going to be seeing companies getting sued all the time over alleged biometric data violations and things of that sort, but nothing really out of the ordinary here, just the usual stuff that you see with companies. But you will see here that the P ratio of the company currently is sitting at 18 with a price to free cash flow at 19 here, which is great for a company of Google's caliber. Now, if it goes even lower, that's obviously even more great, even more amazing. But where it's sitting right now, it's a pretty nice opportunity for adding this company to a portfolio over here. And the outstanding shares that are going down and will keep going down, because obviously at this current price, Google has nothing to do other than buy back its own stock. And this is exactly what they are doing, and they have been doing. And so you're going to be looking at the board, pretty much purchasing back a lot of stock, becoming treasury, and basically taking it out of the market. It's a fantastic opportunity right now with all the cash that Google has over here. I should say Alphabet. It's a prime opportunity to be buying back shares. And Meta, Google, they won't be finding so many opportunities in the future to be buying back shares at that cheap valuation right now, as the value of both of these stocks are right now. This is not bound to happen for many years. And so right now it's a great opportunity for them to be buying back shares, and this is exactly what they are doing, because they are smart, and they will be buying back their own stock now when it's actually cheap, not when it's going to be higher again, and when it's potentially going to be overpriced, because I'm pretty sure that it's going to be happening in the future at some point. Now, of course, in the current market, again, it could last for a little while, maybe 1 2 years, who knows, in which we're going to be getting suppressed valuations. That has a lot to do with pretty much policies and governments, and of course, whether they will be able to tame the inflation that they caused. Okay, so in terms of liabilities, the company has very little here. 1.6 is the ratio compared to the free cash flow that the company generates. And the numbers, the key metrics here, revenue growth, net income growth, free cash flow growth, they're all insane. They're amazing here, as you'll see. And we'll examine them in a little bit more detail using our financial statements here. And net income margins that are similarly very high. Again, companies like Google, Meta, all of these companies, Google hasn't been down a lot, like 34% compared to Meta, which has been down like 62%. But these companies are making tremendous net income margins here because they are software based. They don't have a lot of costs pretty much for, let's say, goods, for the production of goods over here. And so this is why they tend to have great returns here. And return on equity is also pretty great here for Google. Okay, so what about the financial statements? As you'll see here, you can kind of take a peek and see that the company has been increasing the revenue at an insane pace. The company made 257 almost billion over here, a little bit more in 2021, which is insane. This is a lot of money to be making in a year. And look at this growth over here. And what about the net income? Similarly, insane growth, like a six-fold growth here. This is insane amount of increasing your net income here. These kinds of companies should be trading at a more lucrative valuations for sure. So right now it's definitely a prime opportunity to be adding these ones to the portfolio, especially since we're coming off of a market that was deeply overvalued, and a lot of these companies had massive P ratios, for instance, or price to free cash flow ratios. Right now they are sitting at a very fair valuation for what they are. In terms of the balance sheet of the company, obviously, it's the time. It is now the time to be buying back your own shares, right? And so the company has been purchasing a lot of common stock, even though their retained earnings still keep increasing over here. Their total equity is still increasing, even though, again, they're purchasing a lot of stock, and they keep purchasing a lot of stock. And their total equity from 152 has grown to 251 over here. Again, tremendous growth. Total liabilities of 107 billion here, and if you take a look at the cash flow statement, you will see that they just paid 67. They just got 67 in free cash flow last year, which means that it takes them about 2 years of free cash flow to pay all their total liabilities, meaning that they're super solvent. They don't have a lot of debt. They don't have a lot of liabilities either. So they just don't have a lot of money to pay back to suppliers, for example, or a lot of debt that they have to fulfill. In terms of their net income here, you see that it created 91.6 billion in operating cash flow, which translates to 67 in free cash flow after paying back for capital expenditures. And you will see here that the company is repurchasing common stock, what I told you earlier. Take a look at these common stock repurchases here, becoming wider and wider over here. And right now, sitting at 50 billion last year, imagine how much more they're going to be buying as the stock price is falling. And again, this is a prime opportunity, and this is exactly what I would do if I were in the board of the company. You won't be getting a lot of opportunities to be buying back your own shares, your own stock at this insanely low valuation here for a company of this caliber. And in terms of the cash that they hold, 21 billion here, and the free cash flow at 67 again from 24, again being increased pretty much every year at a tremendous pace as well. And if you take a look at the stock evaluation tool, it will tell us how much it makes sense to be paying for the company. And again, the revenue growth that we're going to be using is going to be much less than the one that they have been achieving lately. Like last year, they had 51%, 41, which is insane in terms of the revenue growth. We're going to go much lower. We're going to go 5, 8, and 10 here for the revenue growth for the next 5 years. Net income margins, the company has been making close to 30%, it looks like, increasing from the previous years. And so I'm going to go 27, 28, and 30 here, closer to the one that they have been achieving, maybe a little bit less. So this is why I'm using some lower net income margins here in my lower estimates. And free cash flow margins of about, I should say, 90, 100, and 110 maybe percent. This may be a little bit more than I would want actually, because 110, it's only 1 year that they have actually surpassed that. So I will go a little bit lower. Let's go actually 90, 95, and 100. So 110 may be a little bit too much. Annual return of 13%. And let's hit calculate here. And let's see what we're getting. And you will see that with this revenue growth of 5, 8, and 10%, which is obviously very little, we are sitting at the medium one pretty much being where our current price is. And the low one is significantly lower because, again, we're having a revenue growth of 5% and net income margin of 27%. So anything below 100, and I have long told that, is an insane amount to pay for this company. I think it's a great valuation. And for me, it's a definite buy. I bought it at 120, near that, a little bit more, I believe. And I was still very happy with my purchase. And as it goes lower, I mean, you have to be even happier, because you have to remember that these kinds of companies sitting at a 20 P ratio at 20 to price to free cash flow, and being a little bit more expensive, they are great to accumulate for the long run because they have massive advantages. They're buying back shares, they have great margins, they have great returns on equity, great returns everywhere pretty much. They're increasing their revenue pretty much annually. They're increasing their net income. They're increasing their free cash flow. They have no debt, so they are free cash flow machines. So there are a lot of positives about this company and these kinds of companies for which it makes more sense to pay a little bit more. Now, of course, you don't want to be paying, let's just say that this was like 75 and the current stock price was like 200. That's a different story. In that case, it would probably be much, much more expensive. But if you're getting like a medium of 100 and the current stock price is 110, it may be a good opportunity to add to a portfolio, especially if we're talking about these kinds of companies with all the positives that I mentioned earlier, because it's always better to pay a little bit more to get a great company than just pay as cheap as possible to get an average company, to buy an average company. So paying a little bit more to get quality makes sense. And if it goes even lower, then more power to you. You can average down and get even more stock of this fantastic company and other companies of this sort. But this is how I look at these companies, and this is how I buy my stock. Thank you for watching. Remember to leave a like and subscribe if you are not a subscriber already. Remember that you can become a patron and get access to our tool by visiting the links in the description box below this video. You can become one if you desire. And I'll see you in the next video. And also, remember to leave a like and remember to leave a comment and tell me what you think about Google, whether you own it or not, whether you're thinking of adding it right now to your portfolio as it's going lower and lower. And again, currently it's probably going to be sitting at about 98 when the market opens, which again, I think it's tremendous. Do tell me what you think about the company, and I'll see you soon in the next video. Bye-bye.